Janssen, France, stay mainly in your pants. All right, good morning, everybody. It is approximately 8 o'clock in the morning. It is Thursday, December 3rd, 2020. Welcome to Forex.Today. Today we're going to do technical analysis of what? Of euro, of dollar, of yen, of Swissy, of pound, of kitty cat, of Noki, of oil, of gold, of Bitcoin, whatever you want. Let's get on with it. Let's go! So let me remind you that trading's risky. I'm dropping food all over myself. Let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hey, good morning. How you doing? M&M's for breakfast. More. Hang on. It's so good. Good morning, everybody. My name is Wayne. I'm a currency trader. I love being a currency trader. Trading currencies are the way to go. Buying and selling money. Cool. So, what are we here for? First of all, we're here to just support each other through this tough thing called Forex. It's hard being a trader. You give up so much. There's so much sacrifice, and there's so much focus, and there's so much stress. And well, it's just nice to know that you're surrounded by other people just like yourself. So that's one reason we have a community. Second of all, we're just sliding out of the London lunch period, sliding into the New York Open. So it's a good opportunity to enter new trades. Things like gold and oil typically are really good trades this time of day. And then, of course, we start, want to front-run news or front-run the stock market open. This is the right time of day for doing all that. So that's why we meet today, or this time of day. Also, I want to teach you how to put together trade plans. So your trades that you're going to, if you're going to take trades in the next hour or two, these are the things that we talked about yesterday. You should have had them planned out yesterday. It's not like you just show up, pop open a chart and like, oh my God, there's a trade right there. That's failure. So I'm trying to teach you how to plan your trades, and we will probably find trades for tomorrow today. So that is sort of the raison d'etre. I want to teach you how to plan trades, not just put you in a bunch of trades. Yeah, that's fun and sexy, but actually, as I showed you yesterday, it's actually slow and boring. So the big money is knowing how, the big money in any business is being able to add value. So the value comes from careful analysis, thoughtful consideration, and patience and discipline to execute. So I'm here to teach you how to create value. Cool. So I'd like to thank Traders Way for being part of our community as well. If you're a foreign exchange trader, you're going to need a foreign exchange broker. Hey, guess what? You want to be a successful trader, so you want education. They're trying to lure you over to them so that they can earn your loyalty and respect. And what's the sexy bait besides the beautiful hair? Your success. Right? They're like, hey, Wayne, why don't you use education to help people become better traders? Because if there are clients and they're better traders and they trade a little bit more profitably, a little bit more successfully every single day, they're going to be around for years and years and years and years and years as clients. And so we want our clients to be successful because it's a better business model. And I'm like, symbiotic relationship. Okay? Yes, the spreads are low. Yes, the swaps are big. Yes, the execution speed is fast. Yes, they have world-class customer service. But ultimately, the business model makes sense. And I hope you buy into that. Hey, I got this thing in the way. All right, so let me get going, except I got this window in the way. Hang on. The window to the Wayne. All right, got to move this over there. I got to close that. Holy smokes, this is complicated. All right, I guess we'll have to start over. I don't know why that was muted. All right, so let's start all over again. And apparently there's a lag too today on YouTube. Wow, huh? Let me check something. Why is there a lag? I guess I can't go back and check once I've started. Huh. All right, well, yeah. All right, well, anyways, let me go back. My oh my, WTI. So Monday was supposed to be an OPEC meeting. At that OPEC meeting, they're supposed to come to an agreement of like a proposal of some sort of deal. Then on Tuesday, they take the deal to the OPEC Plus meeting, which is the other oil-producing countries, particularly Russia. Yeah, they throw in Mexico and a few others, but it's the OPEC Plus meeting, and they're supposed to say, hey, OPEC Plus, this is what us OPEC people came up with yesterday. But because on Monday they didn't do it, then there was nothing to talk about on Tuesday. So guess what's happening today? Now it's the OPEC Plus meeting. So maybe today we get a decision. Okay? Now, where are they going to decide? I did a quick look, but it's a little fuzzy. But I think the cut was 10 million back in March, and then they moved that to 8 million. So it's already up since the major cut. And I think they're deciding whether they should cut this to like 6 or leave it at 8. If they cut it to 6, it's a cut of a cut, which is a raise. It's sort of like Biden's not raising taxes. What is he doing? I forget. It's some sort of description of not raising taxes. I'm like, wait, that's raising taxes. So we're actually, if they say in January, there's actually, like, if there's less of a cut, it's a raise, right? So if they say less of a cut, then that's a raise, and that could probably be bad for oil. If they leave it as expected, then, well, that's what's already priced in. What else could happen? Nothing really likely. So anyways, maybe we will get a decision, and we will see where we need to go. Well, Jean-Guy brings up a good point. The oil stocks or oil inventories are down 9% from last year, but that's not that. Yes, but you also have to realize that that was 100% capacity. So it's more like, even though we're down 9%, what is that relative not to peak, but to historical norms? So you want to look at the 5-year average. Okay, average. And then what they do is basically a standard deviation. So you have your average, and then you have like the amount of oil above the average amount of below over a period of years. Okay. And even if we're down 9% from last year, if that means oil is dropped from here to here, it's still too much. So, right? So what we need is, so the OPEC cuts worked, I guess, is another one, right? Right, so that's still bad is all I'm saying, Jean-Guy, right? So 9% improvement's good, but it's still 7%, right? So anyways, for oil to go up, we need supply down or demand up. And really, we're looking for evidence of both. And this market is still normalizing as well. So that's sort of the backdrop of what's going on. See, a year ago, there was an oil war, and the price of oil went to zero. So have we recovered from that? When Russia meets with OPEC today, literally right now, what's the relationship like? They just had a war, right? So it's going to be, it's tough. And then, of course, as I mentioned before, when it comes to a cartel, in game theory, everyone in the cartel is incentivized to cheat. So what happens is OPEC agrees to cut oil and drives the price of oil up because of supply falling. Meanwhile, Libya's like, psst, hey, do you want to buy some oil? Right? Because now they said they were going to cut, but then they start selling because why not? You're getting the highest price. You're the only supplier in the world, besides Canada and the United States, right? So you're incentivized to cheat, and then, of course, the Russians are cheating, and everyone's cheating, and whatever. And it's just how cartels work. That's why you got to be like Pablo Escobar. You cheat, there has to be a consequence. Okay. So anyways, so oil might go up today, even though it's Thursday. Thursday. Okay. We're just still same buy some, same everything. Is $46.80 for the day? Do I think it's possible? I wouldn't use language like that. What do you mean anything's possible? The conservative target is 46.28. The aggressive target is 46.76. But that's not for the day, that's for the week. Okay? So Victor says 46.80 for the day. I'm like, well, that's pretty aggressive for the day. And I don't think we're going to get news out of OPEC that says, oh my God, this needs to move up another $5. Right? I mean, I know you're not saying that either, but that's the weekly target. So by today or tomorrow, after non-farm payrolls and stuff, I would say probably not, because we should be up there already. So it's Thursday and we haven't even moved yet. Nah, I don't think we're going to hit that. We could, of course. Is it possible? Of course it's possible. But it's Thursday and then Friday, so we haven't done anything Monday, right, Tuesday or Wednesday. But maybe it's all pent up because Monday we were supposed to get a deal, but we didn't. And then that was supposed to get the OPEC Plus deal on Tuesday, but we didn't get the meeting Tuesday because there was no deal here. So finally, it's Wednesday. So maybe the market's just waiting. Yeah, sure, it's possible. But you're going to need, I think, a continued cut at current, right? See, I think what's on the table is less output than they would like, but really they're going to raise 200,000 barrels or something, right? So I think for you to get oil that high, you're going to need at least keeping production at current levels. At least. Okay? Not only that, what Forex pairs do you normally trade? All of them. Money is money is money, honey. I should actually temper that. I trade major pairs. Right? I don't trade a lot of Polish zloty anymore, and Iraqi dinar, no. Okay? All right, so that's that. Biddy's still trapped, but at the top of our range. Very nice. Okay. Beautiful little entry off of our buy zone. Okay. So I'd be eyeballing sort of this area in here. Right? That's what I'd be eyeballing if I were me. Oh, of course. Do I stack trades, multiple trades for the same pair? One long-term, one day trade? Absolutely. Hey, Rossi. Romu. Well, Jeff, even in the United States, leverage is maxed for Forex at 50 to 1, and futures contracts are 40 to 1, so that's how it is, bro. Because it's not even the brokers that are doing that, that's the exchanges and stuff. I mean, so anyway, so that I don't think you guys really trade natty. We could look at Goldie. I said 1845. I'm sorry. I apologize. It only got to 1844. Can't quite see what the top of this one is. Uh, 1843.66. 18. $43.66. So I apologized. I apologize. $1. $1.30 off. Sorry. You guys remember doing that at the beginning of the week? Does anyone remember that? No? It's all gone? It's lost in antiquity? Too bad. So sad. Too bad. The reason we were doing this, it was down in here. If you recall, I said there's nothing that says down. So therefore, you need to be planning if you're a bull for an up. Now do you remember? I said it's been falling for weeks and weeks and weeks. which means if you're a bull, you need to start preparing, right? You can't live in the past. You have to plan for the future. Now, does it ring a bell? And then we consolidate it, and I'm like, hey, dude, hello, right? You don't remember all that? Like, come on, wake up, come on, Bubba, come on now, right? Now we hit 1845. I suppose now you want to buy it. See, that's the problem, right? It's been falling for weeks, so now you want to sell it. And now it's been rising all this way, so now you want to buy it. You see the backwardness to it? Okay? That was straight up in the face of this giant downward move. I'm like, if you're a bull, I think the speech was like, you need to, the value proposition, like you need to plan. If you have a bias, if you think dollar's going to fall for the next 5 years, all this stuff, like this is your alpha, your ability to produce, right? Now it looks pretty good. Okay, now it looks pretty good. Whale oil B. So now it's going to hit 1845. Amateurs are going to start buying it now, and they're going to run into some trouble. Oh, for sure. Okay. Anyways, that's how it's done. Marina got it? Very nice, Marina. Awesome job. Got it at 1780. Yeah. Oh my God, that's nearly perfect, huh? Very good. Gerard says, hey, what's your minimum risk-reward ratio? 3 to 1, 33.99. But I try not to... I mean, sometimes I'll 50, 150, 100, 300. But the thing is, it really comes down to the type of entry. And I rarely want to take pips that are less than 100. Like, I'll feel bad if I'm like, oh, crap, and you make 50 pips, right? It's usually very disappointing. So... it's not necessarily a risk reward ratio, although we talk about it in the training courses and stuff. I'm much more concerned with trend because, right, like when you're trading with the trend, your risk reward ratio is always favorable, right? It's 10 to 1. So it doesn't come up as a question. A smaller trading, yeah, like if you're risking 30 pips to make 20 pips, you're foolish, right? So, but that doesn't come with day trading, swing trading, position trading. It's just not really meaningful, right? Because it's just built into the strategy, if you want to call it that. Someone wanted to know euro dollar. We can look at euro dollar. Okay, so we're coming up close to my target now, which are my, what was it, 22 and a half, right? So I have to go out to here. So I'm in at 17, and we're almost at 22. And I'll have to bail pretty soon on these. I might be done pretty soon. Okay. What do you guys think of that? So let's see. So I've made 400 pips since yesterday. In those euro dollar trades, euro dollar, 461 pips, 450 pips. Huh? Do I get a like for that? This one here, pound yen, is about to hit 500 pips. Whoop, whoop. Yeah. Everything planned weeks in advance. These are only 6 trades. I asked you to be on 35 trades. I wanted you at this period of time. I challenged lots of people to try to make 10,000 pips. Okay. Dr. H is done for the year. Well, done for done on the position trades. Okay. Should got 7,000. Very nice. But the thing is, I prepared you and I asked you and I got you mentally focused and prepared to do it. Right? That I said by the end of the year, I'd like you to be on dozens of trades and I'd like you to make at least 10,000 pips. But, right? So I'm hoping that this was the year that we sort of broke you through, broke on through, right? To the other side. On 8,400 pips. Very nice. Congratulations, guys. Okay? And you'll see, like, if I can do 2,500 pips on 6 trades, if you had 12 trades, if you had 30 trades, then now you can see, you can see the plausibility where, again, I get emails from people, like from professional groups that say, you should trade with us and you should take my training course because we made over 300 pips this month. I'm like, oh my God, right? Right? When I'm trying to get you to say, there are times in the year that where you need to prepare and be worth more. I want you to go for 10,000 pips in a month. And if someone says, well, we're professionals, we do 300 pips a month. And then I come up to you, you're like, no, you should be doing 10,000 a month. Not every month, but right. But you should be going for 1,000 pips a month. And there are other months where you can get 10,000. And if someone's like 300 and someone else is 10,000, you're like, it's out of the world. It's out of the solar system. It's from a different universe. It's from a different dimension, isn't it? Yeah, Raymond, 13,500. Yeah, very good, Raymond. See? But you have to get there, and it's unbelievable in the moment if you don't know. But now that you know, you're right, you're blessed with this knowledge. Now it's a skill that you own, right? And so like the newer people that come in, they're like, what's the right risk-reward ratio? What do you mean risk-reward ratio? Those trades are taken with, 30 pip stop losses, right? Every one of those trades at break even, and there's 13,500 pips. What do you mean risk-reward ratio, right? The total accumulated risk at the point of entry was never more than 30 pips, meaning right? Let's take Raymond's trade. Let's say he's on dozens of trades. Well, on one day he takes a trade, moves the stop to break even. Maybe there's 2 trades that day. Ooh, big day, right? But then by the time he adds 2 or 3 or 4 more, all those first ones are already at break even. So like there's no more, the maximum accumulated risk, let's say, was less than 100 pips total, right? There might have been one day where he was on 5 trades or something, right? So anyway, so the risk-reward ratio is still the same. You risked 100 and he's up 13,500. So what's the risk-reward ratio? You're like, it's 13 billion to 1. But that's not the issue, right? The issue is planning, having strategy. And here's the thing. Raymond and I, and the swing trading group, right? We talked about this in February and March, even before COVID, and then after COVID, right? In April and May, in June. And I still remember June when I'm sitting on the beach, smoking my cigar, drinking my coffee, doing my morning webinar, going through the charts. And I'm like, Raymond, do you still got that portfolio open? He's like, yeah, I still got it. I said, you're right. I said, the challenge is to stay confident and have the patience to see it through. It's going to be frustrating. Right? And someone else will come in and say, dude, I want to make 13,000 pips like Raymond did. Like, dude, Raymond built that up, right? That wasn't a get-rich-quick scheme. That took fundamental analysis. That took patience and discipline. And when I say patience and discipline, you don't even understand what I'm talking about. That's like losing sleep, patience and discipline. Trust me, when the markets drop 300 pips, it's heartbreaking because you're in 14 trades and you've been sitting on it for 18 weeks and all of a sudden the accumulated drawdown, it's not really a drawdown, but peak to trough on that period. And you have to like search deep in your soul and you're like, okay, well, the Fed told me, right? Like, I'm sticking with the Fed. I don't trade against the Fed. The Fed set this up. The Fed maketh, giveth, and the Fed taketh away, right? I have to stay with this. Right? It's crazy. Right? So then when you see Raymond in his Ferrari, you're like, okay, it makes sense to me. At least it feels like that. Hey, Raymond, do you feel lucky driving that new Ferrari? No, I don't feel lucky at all, right? I listened to an interview today, actually. This kid became a billionaire, right? His company got bought, and he's 25 years old, and he's now a billionaire. And they asked him, like, so how does it feel? He's like, well, there's part of it that it feels like unthinkable, hard to believe, just like, it's unthinkable. And then he's like, but the other half is it totally makes sense. I worked really hard on this company. It adds real value. There's nothing else like it. We have a long-term vision, a long-term game, right? And he's like, so it totally makes sense that I'm a billionaire. But at the other side of it, it's hard to think about it because like, oh my God, I'm a billionaire, right? Like, what does that mean? So you want to get to that point, and this is, and I'm not sure if I talk about this in the book or not, but there's a point in your career that the success is the challenge, right? Right? The success is the challenge, and the reason you can sleep at night is because you've done the work, first and foremost. You've done the work, but you've also been through the pain and you've learned the lessons. You're battle scarred, right? And so later on when the success comes and you're not doing mini lots, but you're doing bigger than that, right? Right? Right. I remember getting a phone call from my broker and they're like, you're going to hit the $1 billion mark for the month. I'm like, I know, right? Right? Like, how do you sleep when you go from mini lots to bigger? You've done the work, right? You've been through the pain and you grew slowly and steadily where it's not just suddenly like trading the lottery or you know, I don't know. It's just you're there and you've matured through the process, right? That pain and that suffering, but the patience and the discipline and the planning and the research and the conviction, the experience under your belt, you get better through that for sure, leads you there. Now, this is why leverage is terribly dangerous, especially in the hands of an amateur, because even if they get things right, they don't have, right? They don't have that last piece, right? right? They don't have that last piece. They don't have the experience. They don't have the conviction. They don't have the confidence. Right? A degenerate gambler knows they're gambling. They know it. It's not a skill. Right? So I've been studying athletes a little bit. Not just athletes, like the world's greatest ever kind of athletes. And there's a documentary about the Chicago Bulls in the 1990s. It's like a 6-hour documentary, maybe even 8-hour documentary. And I find it interesting. I wanted to watch it because I wanted to see if Michael Jordan would talk about not all the things that made him great, but all the things he had to give up to be great. And I'm not sure if he gets quite there, but you certainly get his attitude. Okay? But there was sort of an interesting confluence that happened the other day, because in the documentary, one of the hours is focused on Dennis Rodman. I don't know if you remember him. He was cross-dressing. He'd spray paint his hair weird colors, and he did a lot of things off the court that got media attention, and he was a crazy, weird, bad boy, So how did he get on the world's greatest basketball team of all, not just at the time, of all time? Like, what was up with that? And then you hear all the players, and they're like, yeah, he's totally weird, but I want him on the floor with me at all time. We want him on the team. We need him on the team. And then there was a time when he wasn't playing, and they were losing. And they're like, but this is the weirdo, right? Why do they need this guy? Well, when he's on the floor, he out-hustles everybody. Right? Like, he doesn't have a medium switch. You get 110% at every moment. And then he leaves, and he's not a really good teammate per se, but he'll help you win games. And I'm like, well, that's an interesting attitude. Like, I like the idea of hustling better than anybody else. Okay. So now I'm watching on Netflix a few weeks ago, I watched Uncut Gems. Adam Sandler, the comedian, is in this like really dark, tense movie. And Kevin Garnett, another basketball player, is in the movie. And he plays himself. He plays Kevin Garnett in the movie. And he's like the NBA star that can afford to buy diamonds, right? Okay, so he's buying diamonds with his entourage. Well, Kevin Garnett is a basketball player that's known for being an incredibly hard worker. So he goes to a franchise, he gets drafted to a franchise. The whole franchise changes because people are looking around and they're like, dude, he's practicing harder than anybody. He shows up before everyone, he stays longer, he does more research, he works out, he stretches, he shoots, he's like, and he gets everyone together and changes their regiment, and like, he's the hardest worker, right? So he's promoting the movie now, and of course, because he's one of the greatest of all times, a Hall of Famer, I would imagine, right? They're asking him lots of basketball questions, and about his discipline, all that. So that's where it came up. I'm like, oh, good, another example, right? And then he said one day they were playing. I think it was the Chicago. Yeah, it had to be right. They were playing the Chicago Bulls. I think he was at Boston at the time, right? So he's a Boston Celtic. And he said they played a playoff game. So it's the end of the year, like they've played 84 games, and now it's playoffs, and you're just maximum capacity the whole time, right? And Kevin Garnett is a maximum producer at all times, right? So he said they lose the game. It was close, but they lose to Chicago. And he's like, he was so tired he skipped the press conference and stuff, not because he was sad that he lost, but he's like he couldn't compose himself. Like he was shaking. He was going to like lay down. Like he couldn't hold himself up. He had given so much and mentally just shattered, right? And he's like, I couldn't even be in the locker room. I just needed to be alone. I needed a quiet space. So he's like, he made his way to the workout room, right? And he's sitting there, and he's like, he can barely hold his body up. He's just sitting on a bench or something. And he's just like, oh man, he's just literally about to just melt onto the floor. And then Dennis Rodman from the other team kicks open the door, walks in, and he's like, hey, what's up, baby? and Kevin Garnett's like, what's this guy doing here? And when he went over to the treadmill, lifted it to a 45-degree angle, and then jumped on and started running as fast as he possibly could. But he just played 60 minutes of a playoff game. And Kevin Garnett, the hardest worker, most prepared, most physically fit person, is staring at Dennis Rodman sprinting on a 45-degree angle. But Dennis Rodman had just skipped the shower, put street clothes on, and he's running, doing this 45-degree incline, running in combat boots. And Kevin Garnett's like, he had never seen that in his entire life, right? A beast looking at someone else going, wow, that guy is beaster. Like, he's a bigger beast. Like, it's amazing. And I love these stories because it had nothing to do with, like the Bulls documentary obviously is going to say nice things about the Bulls and all that kind of stuff. But this is a totally side story going on here where Kevin Garnett, known to be the hardest worker, was in awe at the work ethic of the crazy lunatic weirdo Dennis Rodman. And you're like, that's why the Chicago Bulls were the world's greatest to ever play, because they were all like that. How do you get an entire team of people like that? Well, obviously it starts with Michael Jordan and then outward, right? But you're like, oh my. And I love those stories where you're like, he earned it. He worked harder than the hardest working people. That's what I like. Now, the thing is, we need to bring that, that attitude and, of course, the actual work ethic to what we do. Right? Right? That's the secret sauce, guys. That's how you get rich quick. You work harder and longer than anybody else is not just willing and able, but most people don't even get it. They don't even get it. So there's, again, I just imagine Kevin Garnett, everyone admires him for his work ethic, and he's sitting there going, watching Dennis Rodman going, this is the most amazing thing I've ever seen. Like, someone that's already a Hall of Famer is going, I could have done more. Right? Like, I thought I was peak, and everyone around me was telling me how great I was and how much of a work ethic that I had, and that I was the pinnacle. And that's the problem when you don't have a role model, right? Like, if he had only known, imagine if those two guys are on the same team. They could have worked out for another 2 or 3 years. Kevin Garnett could have been a better player because of the weirdo Dennis Rodman, right? You're like, wow, right? So it's important to know and have that role model. Right? Yeah, and LeBron James is the other thing with LeBron James is, he's talented, right? But he's big, which is another thing. But also, he never gets hurt. And my friend who played professional baseball, he was on the Cleveland Indians for years. He said, so my friend was the greatest pitcher in Canadian baseball history, Olympic team and all this kind of stuff, right? Youngest pitcher to ever pitch in the Olympics and all this kind of stuff. So anyways, so he gets to the major leagues and he's playing for the Cleveland Indians, and he's a young man making whatever amount, but he's surrounded by people that are making $40 million a year, right? And he said, there's something about these superstars, like a LeBron James, but now we're talking baseball, right? He's like, there's somehow they can see faster, like literally frames per second, and therefore they can hit, right? Especially the home run guys. Somehow they can hit balls that no one can hit. They just are able to, the coordination, but just seeing the ball and timing it, like they were abnormal. Like they just somehow had something that they could do something that no one else could. Well, that made you pretty good in baseball, let's say, in many sports. That gives you an edge. You're better than most. But he said the things that make you superstar, right? Hall of Famer superstars, is that you can hit the ball, run faster, throw faster. You got your whatever your niche is. And you get hired by a team for your niche because someone says, we need someone that can steal bases. So you find someone that can steal bases. And of course, that guy is superhuman at stealing bases. Or we need a home run guy. Okay? Can't steal bases, but if he hits the ball, 60% of the time, it's a home run every time, right? So you're like, okay, so each team sources a talent for whatever reason, right? But my friend said these guys have that talent, but they're a freak of nature beyond that because for some reason, they don't get hurt. For some reason, like they're unbreakable. You play 100 games a year, right? My buddy's telling me like everyone is just loaded up on painkillers by the time you get to the end of the year. And you're praying, you don't want to go to you don't want to go to playoffs because you're hurting so bad, right? You're like, just end it, right? You're in a world of hurt. You got 9 injuries that are bothering you, except for that one guy that goes out and home run, and he's like, yeah, I'm the world's greatest, and he's running around the bases, right? Gets in his Rolls Royce, and off he goes to the next party, drinking champagne and all that. And you're like, dude, how does this guy not get hurt? Okay. Amazing. But work ethic you have to have. That's the bottom line. And so what's our superhuman abilities? In Forex, like once you know how to trade, that's one thing, right? And maybe this is a lot of why I do webinars too, is because the next step, once you get to these different levels, and like you're not trying to like figure this out or trying to be profitable, there's a different level, but I find like complacency is a devil that you're always fighting. And I battle that with inquisitiveness, right? And I try to like, I'm not trying to change the way I trade, but I like to look for information and be, what is this about? What is that about? Right? And doing webinars with you, we can talk about things out loud and explore these ideas together. And it keeps me, interested because you don't want to ever want to become dull, because dull will lead to your losses, right? And so our superhuman strength here is doing this for 20 years and still being interested. Right? You don't want to become complacent. So that's why I teach, because I'm really teaching to myself as much as I'm teaching to you, right? I'm reminding myself, this is where I get my strength. This is where I plan. This is how I do this. This is why I think this. You're constantly pushing to be at peak. It's hard to be at peak performance for 20 years. Okay. There's our Mexican peso short trade from Monday. Okay. Something I've been teaching for 10 years? 12 years? Every time it's the same. But you got to stay inquisitive. Right? Okay? How would you like to teach this one trade almost every month for 12 years? Knowing that of the thousands and thousands and thousands of people I've taught, 8 will do it. Right? Right? Oh, Henry got it? Yeah. But isn't it a funny feeling? Jean-Guy got part of it, right on. But isn't it a funny feeling? Imagine you knew if you told thousands and thousands and thousands of people, 8 to 10 might listen. It's crazy, right? Well, I know whether it's like, have you ever done door-to-door sales? Have you ever had to do that? Yeah, I guess so. Yeah, apparently so, right, Marina? Yeah. So, anyways, I hope, right? I hope that the effort that we do as a community, I know, right? It's the 3rd of December, but like I remember, it's amazing. Like I almost remember every webinar of this entire year. It's really amazing how it's come and gone and the years gone by. The different things we've had to talk about, the different perspectives, the different adjustments we've had to make. I hope it's been a good year, like really a breakthrough year for you. For some reason this year seems a little different. It feels like it was one giant lesson because I've had to focus you so much at first seasonality and then second crisis mode, right? And then I really had to push you to get out of crisis mode. It was really difficult to get you guys out. Like, I'm like, right now, today, create a list of 8 companies you want to buy but couldn't have bought before because it was too expensive. Like, you need to buy something today, right? You got to get out of the dollar. Imagine, I said, I am now short the US dollar for the next 5 years. You're like, but it's the strongest currency on the planet, Wayne. Why would you say that, right? Like, I really had to push and say, don't think about economic data. Don't think about news. You have to learn the difference between news and fundamental analysis. And I said, everything in the news is end of the world bad. You should be buying. Right? So, holy crap. Luckily, that was the right call. Maybe not luckily, but as a lesson to show you the collapse, but then how to profit. Right? How to be strong, how to react logically. And now we're at the end and you're like, oh, I got 8,000 pips and stuff. Okay, great. This will be how, the year won't unfold with an exogenous shock, but, right? But now you know how to handle crisis. Like maybe this year I could say, well, I taught you how to handle crisis and crisis management and stay logical. I don't think you ever saw me freak out and get all wild and crazy. And, I think every single day it was logical and intelligent and focused on, how to survive and grow and pull this together and be the professional. I remember asking you to step up and be the professional you plan on being. And you need to be that now. And there will be more crises in the future, and you will know how to handle this. Okay. Boop, 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 boop. Gonna get rid of all this. I think that's distracting. Boo, 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 boo. All right. Let's get on with it. Let's do another. Let's pull some of this up. Okay. Now what? 618 predicts 1382. Isn't that nice? Peter wants to know at what point I want to take profit on euro dollar. Put it this way, you have to make a decision. All I know, okay, because I don't want to tell you what I would do, because then you're just trying to figure out what I would do in the future, right? So here's how you make the decision, okay? I told you guys yesterday or the day before that I know between December 1st and December 21st, I will take profit. Done. Guaranteed. So the next thing is, you know it's coming, and it might be today, it might be tomorrow, it might be 2 weeks from now. So you'll need to now use technical analysis the best you can to decide how or when to get out. Okay? But you know you will. That, to me, that's not a question, right? I'm not even thinking about, should I get out soon? Oh, I know between now and the 21st, I will be out for sure. Oh, for sure. I'm not a problem. So at what point? Well, here's the other thing I want you guys to think about it. In 3 months, when it's on your track record, do they see whether you got out at M4 or R2? Richard, you trying to get into FX Bootcamp? Just fxbootcamp.com. Okay. So think about it, guys. People don't, when they look at your track record, they don't say, oh, he got out at the conservative M4, but she could have stayed in a little longer and got the R2. She left 300 pips on the table. Now, what do they see? If I bailed on my trades right now, what would they see? 2,500 pips. They're like, dude, this guy got like 7% for the month. Yeah. That's all they see, right? So to me, when people are making these decisions, they're looking at it through an emotional lens of, could you have gotten more? Could you have gotten less? Could you have made a different decision? Could you, should you, would you? Ultimately, nobody gives a damn except you. Right? So this is why you have to understand your your track record, your history, the psychology of your investors, the psychology of the market in comparison. Okay? So I had a conversation yesterday and then today with Coach Ryan because we're doing some programming and stuff for yet again the next iteration of the professional program. But we were talking about the Sharpe ratio, and because he wanted to know what ratios would be important and all that kind of stuff. And I'm like, well, you have to, don't do a Z-score, but, let's do a Sharpe ratio because people are going to look towards that. And I was explaining, like, if you tell someone you made $30,000 profit, they're like, okay, is that good? Is it bad? What kind of risk did you have to take for it is another question. And so you're like, okay, well, to look at the riskiness, you're going to you would look at a Sharpe ratio. Okay? Okay? So what you want to do is say, okay, what percentage return did the trader get? Let's just make up a number. 10% for the year. But what about the opportunity cost? Now, in real estate, this is your discount, right? And same thing, like if you're doing perform a cash flow analysis, this is your discount. In this kind of analysis, you could say, well, you might say the investor could have just left money in the bank. The investor could have just bought some treasuries, because doing both of those things is risk-free, right? So you subtract out this from a risk-free rate of return, and let's say you could have just bought, let's just say it was 2%. Okay, so ultimately you only produced 8% of value to your client, right? So here's the next question. You could look at this as beta, right? So your return, your absolute return, minus the beta is equal to your alpha, right? So that's the first part. How much alpha did you actually produce? So obviously this could be, you could adjust this depending on the type of analysis you want to do. You might want to say, well, I could have just put this into my retirement account, which is obviously attached to the stock market, and the beta was plus 22, but I only made 10, so that it would be negative alpha, because they would have done better, right? So by changing the beta, right? So anyways, now you made 8%. Is that good? 8% is good compared to the alpha. I mean, 8% is good when you see the beta is 2, okay, and you outperformed, and therefore you created some alpha. But the thing is, what if every single month, but you don't know in what order, you make or lose 8%? So in January, you made 8%. In February, you lost 8%. And in March, April you made, or whatever, and then lost, right? And then at the end of the year, you're like, we made 8% profit. But how do you know it wasn't going to be a negative 8%? Would you think that this is relevant information? Wouldn't you want to know the likelihood of actually having 8% versus negative 8%? It matters, doesn't it? So what you want to look at is the volatility, and another way of doing it to make it understandable is this. Let's change this. Let's change this to let's just let's leave this one. Maybe I'll just back this out. Let's just get rid of this. What is this, a standard? Okay. Oops. One way of saying volatility, let's say, is a study like this. Okay? This is studying an average price with a slope, right? So you guys know this. I don't have to do this. Simple math, right? Y equals mx plus b, okay? Where m is the slope. So what we're doing is calculating every candle rise over run, rise over run, rise over run, rise over run, right? Connecting these dots into an average. So m equals rise over run, right? That which is the slope. Okay, great. So that's the first part of analysis. We don't really care about that in a measure. But what else can we calculate from this? Well, once you know the mean, how far when price goes away from the mean does it typically go above the mean? And again, the mean is a slope. Like we're actually connecting the average price and then connecting the average price over average price over average, right? Connecting them to create a slope. So now we have a linear, right? A line. And then we're doing the regression analysis to say how far does price tend to go above the mean when it's above the mean? And when it's below the mean, how far does it tend to go below the mean? Do you know what we could call this type of study? Knowing the distance from here to here, which is sort of the distance from here to here and the distance of here to here. You guys know what we could, another word to call that? But here it says risk-adjusted performance. Yeah, but I'm trying to teach you what the math means, because most people don't even know what the math means. It's really sad. They're like, look at the Sharpe ratio. I'm like, what's the math behind it? I don't know. Okay, cool. Standard deviation. That's right. And a lot of people are like, standard deviation, oh, I'm not good with math. I can't even talk about this. What does it mean? Well, how far does it typically deviate from the average price? Like, that's what it means? Yeah, there's an average price, so when it goes low, how far does it typically deviate from the average before it goes back to the average? And if it's above the average, at what point will that deviation return? Linear line regression, right? So part of this now is calculating standard deviation. Now, I had to do all this by hand and stuff, like, forget it. That's not the point here. But the point is, you now know that you can do absolute return minus the risk-free rate of return, or even this. You'd probably get the math more like this. You'd get the expected return, okay, minus the risk-free rate of return, right, which I have explained to you equals the alpha, right? Now, the next thing is how much risk is associated with the overall portfolio. Well, like I showed you, if 1 month you're up 8% and the next month you're down 8%, right, then on average you're going to get 0, but you don't know the probability of the next month being a negative month or the next month being a positive month. And that's what we're really trying to figure out. How much volatility is there in the portfolio? Because with that type of performance, it'd actually be moving sideways, right? And you're like, well, next month I might lose 8%, or I might earn 8%, but on the long run, it'll probably be zero. But because the last month was a positive month, it's saying, well, for year 2020, we produced 8%. But as an investor now, wouldn't you like to know like the probability that it would be actually zero? Right? Or it could have just as easily been -8. Wouldn't you like to know this? Okay, so we look at that standard deviation now. So now we can simplify this is the Sharpe ratio by Bill Sharpe, Sharpe ratio, okay, which you need, by the way, you need to know what your Sharpe ratio is. Okay, Sharpe ratio is equal to your alpha, your ability to outperform a risk-free investment or whatever market you're using, over the standard deviation of the overall portfolio. Alpha over volatility. Okay? And a big number is better. Okay? Okay? So, and of course at Harvard I had to do all this by hand. They would just give you this giant data set and they throw some outliers and they're like, describe the skew. And I'm like, describe the skew you, right? But then you'd have to bust all this out. What is the mean? What is the median? What is the mode? What is the slope? What is the intercept, right? Then calculate the standard deviation. What's the variance? What's the standard deviation? You're like, oh my God, right? And then program the whole thing in R, or confirm everything in R. My point is, first of all, you should know what this means and why it's important to investors so that you can produce a track record. Because remember, a track record of success, you might just think that means profitable. Oh, look at me, I've been profitable all year. But there's also you need a good track record of success. You're like, well, I made a lot of money, isn't that good? No, that's not actually what investors are looking for, because remember, every opportunity they see makes money. So you're like, look at me, I make money. And they're like, well, so what? I have 10 other deals in front of me that make money. And you're like, oh, well, how are you going to decide? Aha. Yeah, this is how we're going to decide. No, that's terrible. Okay? 0.11 is terrible. You either have very little alpha or way too much volatility. Okay. Or here's the other thing, okay? Here's the other thing. I can describe what's probably happening based on your 0-1-1 Sharpe ratio. I'm not even looking at your trade history, okay? But I can tell you the math, what's going on. So check this out. This is what's likely happening. You have lots of little losses and lots of little wins, and there is some volatility to that. So one way to get your ratio low is to have a large denominator. Now, here's the next thing. Are you ready? Wait for this. Wait for this. You have several profitable open trades right now. Is that true? You have your normal little winners and your normal little losers, but you're also holding a bunch of trades right now that actually got lots of pips on them. Is that right? Yeah. See, isn't this brilliant? If you know what the math is, you can tell me your Sharpe ratio, and I'm like, I know what's going on in your entire trading portfolio. Okay? So here's what's going to happen. Here's the downside of MT4, of MyFX book, of pretty much probably every single reporting system out there. And by the way, a lot of these like copy trade programs are very fallacious as well, in the sense that you're not actually getting informed data because nobody even understands the math. So they're like, well, look at the Sharpe ratio. And like, I don't know what that means, but I guess it's good. Well, here's what's going on. They're only calculating closed trades. It's like doing an IRR, right? An IRR versus an absolute return is only counting the money deployed, not counting the portfolio performance, just the money deployed performance. I'm like, well, that's not really that meaningful, right? When it comes to your Sharpe ratio, what's happened is it's only counting the closed trades. And what this told me is you have a lot of volatility for very little reward. So you have lots of little losses and lots of pissy little winners, which is normal. And only makes sense, though, if you got a bunch of big winners. Because why would you get out of your winning trades? You're a trend trader. You're a macro trader. So all your trades are sort of like, little day trades here and there, a few losses. It didn't work out the way you thought. So your whole portfolio has a lot of volatility for very little reward, and also is probably fairly close to break even, which is not actually a problem with me. But now, if you closed a bunch of trades and had 3,000 pips profit, let's say, all of a sudden your Sharpe ratio would skyrocket because you got all these pissy little winners and losers, which relative to your big winners would be a small denominator, right? And then, chow, alpha on top. So you're raising the numerator, and all of a sudden you're going to have a very nice Sharpe ratio. So one of the things that we're programming right now is to have a real-time Sharpe ratio calculation and other risk-adjusted portfolios. Now, it doesn't exist in the world. I can't go to my FX book because they're doing all the same stupid stuff that everyone else is doing. They're only calculating the trades you're not in. So think about where this came from. They're not mark to market. They're treating this like you're a stock trader. Right? Right? They're like, because the stock is not marked in the market. You bought it at $18. You could sell it at $40, but they don't know the price until you sell it. So they can't calculate your return until you close the trade, because stocks are not marked to market. We are marked to market. But the calculations that all these other groups and all these other services are providing you, they're not marked to market. So they're like, oh, your Sharpe ratio sucks. You're like, why would my Sharpe ratio suck? All my stops or all my losses are tiny, and I'm sitting on a huge portfolio of thousands and thousands of pips. And they're like, well, we don't count the winners until you close them. You're like, well, that's stupid. I'm getting paid in real time. My Sharpe ratio should reflect my open positions too. Because what if they were all losing positions and I told you, well, look at my Sharpe ratio. I have a beautiful Sharpe ratio. And then you invest in me and I'm like, yeah, but I also have 48 losing trades that are open, but they're not calculated in the Sharpe ratio because I haven't closed them yet. And you're like, well, that was really deceiving. You see my point? People are making decisions on bad data, mostly because most people don't know the math. But if they knew the math, they're like, well, that's bullcrap. Why can't you mark your Sharpe ratio to, oh, well, there's server issues and stuff. So we're beyond that. We're building real-time risk-adjusted performance analysis, because in 5 years, I'm going to have a crew of 30 phenomenal traders that are disciplined to the core. And I'm going to be able to show my clients massive and amazing results with real-time statistics behind them, because it will help them truly, the investors now, truly make an informed decision about the risk that they would be taking and the reasonable likelihood of outcome. based on performance. True, real, clear, transparent, live data. Okay? Not some stupid Sharpe ratio based on only our, the trades we want to close because it'll give us a good Sharpe ratio. And then I could say, well, but if you look at our internal rate of return, you're like, it's 300%. You're like, 300%, but you only risk $3,000, right? Like this one, right? Like, here's the thing, right? I can go to you and say, check this out. My portfolio is up almost 400% now, right? I've risked $600 and I made $2,400, right? My internal rate of return is 400%. Would you like to invest with me? Now, this sounds good now because a venture capitalist will tell you you should invest your money into the VC firm because they have an internal rate of return of 30%. And I'm like, well, I have an internal rate of 400%. But what is that stat forgetting? Well, I only put $600 out of a $36,000 account. You're like, dude, it's tiny. I know, but isn't it good to know that this is an absolute return of 7%, but with an IRR of 300? Like, this is why you need to know what the stats mean, because very often, and this is going to be the advanced lesson here, so you have to write this down. We'll cover this in a mastermind group or something, but at some point you're going to have to sit down with a client and they're going to have a very good question like, I have an opportunity. So like right now, in the last few months, I've had an opportunity to become a general partner in a venture capital firm. I've had an opportunity to become a limited partner in a venture capital firm. So, right? So someone with means is going to be one of your investors, right? And they're going to say, well, I'd like to invest with you, but I got some other deals that I'm looking at. And this VC firm is showing me an internal rate of return of 30% a year. How does this, compare with you? And the first thing you probably need to say is, well, let's discuss things like the difference between an absolute return and that internal rate of return. Because you might be saying you're doing 25%, let's say, absolute return, and they're doing 30% IRR, and the client's like, well, 30%, 25%, how do I decide? And you can say, oh, there's actually a big difference. Let's explore the difference between an absolute return for my Forex fund versus an internal rate of return that a VC would, right? And how they're similar but different. Okay? And then we can go through and imagine now you're going through all these different things with your client, help them understand the other deal. Because even if they don't go with you this time and they decide to go with the VC firm, half the time they make the decision because their buddy's in the VC firm, they want to be with their buddy. Or they'll invest with you because while their buddy talks about the VC stuff and you're drinking your Chardonnay by the pool, you're like, well, I'm in my Forex fund. And they make emotional decisions, not logical. But you're going to have to go through and be able to do the math so you can explain to someone so they can make an informed decision. And to say, wow, if you look at my internal rate of return versus their 30% internal rate of return, well, my IRR is like 400% a year and there's 30. But that's misleading because of inherently why they're using IRR instead of a true absolute return. And now you can go through. Okay? So at some point you got to have the juice to be able to help your clients make an informed decision. And it might be investing in you, it might be investing in somebody else, but they'll always respect you for it. And they'll say, you know what? The smartest person in the room was that Forex guy. I learned so much from that little meeting. I thought it was going to be a sales pitch, and I came out knowledgeable. So I'm going to find a way, or I'm going to find someone to invest with that dude. Right? That's where we're going. All right. So when, Highlander, mark to market. Okay, the mark to market is in the stock market. I'll use the same example. You buy a stock for $18, and it's right now trading at 40. How much profit do you have? 0. Okay? 0. You don't have any profit. None. Now, you own a stock that's currently trading in the market for 40, but you own it at 18 and it's worth 18. Okay? Now, what if this was Forex? You already have, right? You already have the money in your account. Don't think of engineering a Sharpe ratio, but a higher number is better. But don't engineer a result. I want you to think about fundamental analysis of central banking policy. Don't worry about the other stuff. It'll just work out. It'll be fine. Okay? So you don't get paid until you close the position in the stock market, right? And right? In Forex, you're paid in real time. So like going back to this, if this was a stock portfolio, okay, there'd be no, I'm not allowed to place a value on this. Okay? But in this case, I have $2,441 in my account that I didn't use. Like it's in real time, marked to the market price. I've already collected the money. Okay? So that's why I think it's silly to give a Sharpe ratio based only on your closed trades. Well, do you close your winners? No, I don't close my winners. I let my winners run. So now you're like, based on all your losing trades, because even a 50 pip win is a loss. Like you tried to make 50 pips, that's it, right? So those are pissy little winners and pissy little losers. And often the pissy little winners are like, you moved it and you were up 200 pips and you moved your stop to lock in 50, and then the whole thing collapsed on you before you could do anything. And right. So anyway, your closed trades are not your best trades. They're your worst trades. Closed trades are the worst trades. Now drink champagne when I'm thirsty. Right? So anyways, so now what I would say is if we're mark to market, then our risk adjusted performance statistics should be mark to market too. The only thing is we have to program it from scratch and be the only organization in the world with real-time risk-adjusted portfolio statistics for our clients to make informed decisions. Do you see how beautiful that is? That's not the NFA stepping in and saying, you should be transparent and give information to your clients to help them make an informed business decision, because the stuff that they make you do is so cluttered and convoluted and disorganized that it's distracting and confusing to clients, even though that they're the law. And yet I will build something that is the most transparent, most beautiful, most informative decision-making tool for professional investors, that it'll just be a shining light. They're like, oh my God, we don't have to do all these calculations ourselves manually. No, you don't. Right? Cool. Yeah, there you go, highlighter. Cool. All right. Nice. Yeah, stayed away from this one, obviously, with oil risk. So let's go back. Let's go back to commodities. And, okay. And we got to watch now for, we got to watch out for the OPEC Plus meeting. Okay. So this is going to be the thing, right? And wasn't this the price we were stuck on yesterday? Or, yeah, wasn't it? We were trying to get above, right? We were trying to get above 45, I think. Yeah, we got to what? Not quite 45.50, 45.35. So we're just waiting for the news. So we didn't get our news. Oil inventories were not quite ready, not quite good enough. So, you're right. But the thing is, here's the trouble with doing this, is you're waiting for the news to come out to push this up. I'm not even sure if the news can push this up. My fear is this is all priced in, and the real investors got out here last week where they were supposed to, right? That's last week's conservative profit target. And now people are like, give me my money. We got the OPEC stuff next week, so give me my money. I don't want to be in the market. Right? So now they got to get through the news today, non-farm payrolls tomorrow, and then maybe there's up next week, right? So the biggest lesson here is it might just be this was the smartest thing to be doing. Or wait, is this today? Wait, oh, these are dailies. I forgot I was on a 1 minute. All right, so let's pull it back then. So our scalp was in here yesterday then, right? Oh, that's what it was. Here's our scalp yesterday up, and we did make it to 45.50 and above. And then it came down. Okay. And then, so if you were a buyer on this, you should have bought this, I mean, like in here. This would have been very unfortunate. Now you're just waiting for news. But I don't like waiting for news. I don't want news to push me up because as a fundamentalist, you knew the news. I mean, how long ago did we start talking about the OPEC meeting? 3 weeks ago? Right? So like someone waiting for this to take it up now should, right? Remember, I was teaching you this back in here, back in here, back in here, back in here, back in here. Like you should be in at 35 or 40, not sitting here at 45 waiting to go to 50. Like, well, why is it going to go to 50? Do you think OPEC's going to announce a giant cut? No. A continuation? Yeah, probably. A continuation with a slight increase? Yeah. Well, if that happens, this is a little bit down before the up. So I would have to say the most likely news is going to come out and we go to 42 before we go to 50. Right? Okay. What do we do in the live trading group? First of all, you get to meet other people besides just listening to me talk. So we do a lot of group work. So we're going to do group work today. We're going to plan our exit decisions for December. So I can give you feedback and technical analysis and psychological, analysis and discussions about that. But we're also going to do group work where we get together and share our charts and our positions and have intelligent conversations in groups about, how to handle the next 2 or 3 weeks. And then, of course, how to prepare for January, right? So there's a lot to discuss. I think there's also going to be a little bit of slapping on the back, like, hey, good job, high five, high five. But we're not talking about, now we're like, we need to tear down our positions and rebuild. Okay. So we're going to have those types of discussions. So you imagine now talking with 5 other traders just like yourself. Some might be brand new. Some might have been around for 12 years. And everyone in between, and they're working at different skill levels and stuff, but you're communicating together. You might be showing your charts to a group of 3 or 4 other people, and they're asking you questions. And then eventually what we do is then we break the groups back out into one main group, and then we have presenters come in and present their analysis to the group. And again, for group feedback, group thought process, and then, of course, one-on-one interaction where I might be asking you, why your group decides to exit at a certain price at a certain time, right? So it's very, very, very collaborative. It's not just listening to me to preach, because you've already taken the videos. You've already watched all the videos, so you've already heard the preaching. Now it's more like, so like 3 weeks ago, we talked about conviction to get in trades. Then 2 weeks ago, we talked about convictions to take profit. And then a week and a half ago or whatever, I think I'm mixing up the weeks, but right before the election, the conviction to get in the trades. After the election, the conviction to take the profit. The week after that, the conviction to get back in. And then more recently, the conviction to stay with the trades and follow it through, all of which you have planned in advance. Right? You understand? But it's not like me saying this is what a 5A cross is. Watch the videos. But this is really, I think you'll find it'll help you learn how to be a trader, not just trading techniques and stuff, but this is like real discourse, not discord, discourse with fellow traders. You're really learning the art, the science, the technique, and of being a trader and making the decisions. Trading is the easy part. Making the decisions is the difficult, and that's what we focus on. Nothing guarantees you success. No. Okay? You could be a raving lunatic for all I know. I don't know you. Right? It's like, right? So, but I think even if you are a raving lunatic, you might find it interesting and helpful. Right? So anyways. Oh, what's on my screens? My trading platform. Okay. See? You don't believe it? Where is it? Oh, way over there. See? And if you're like, is it just an image? Nope. Look, there's WTI. That's one chart. My oh my, WTI. So that's my trading platform. Yeah. Yeah, and I hope you're not a raving lunatic. Yeah, cool. Oop. There we go. So here we are just sitting now waiting for news, but that's not the right way to trade in my opinion. Bitty, 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 can't you see? Okay. Sometimes your words just hypnotize me. Pound dollar. We can do that one. So I'm in at 29.50 and we're at 34.50. Very nice. Looks like about 400 pips. Okay. Cool, right? Very logical trade. Here's the typical swing. Here's your follow-on swing. Okay. So like going back to where I said, having the conviction to get in the trade, right? Having then the next week, we had a conviction here to exit the trade. And I remember Raymond exited a whole bunch of trades in here, and we talked about it. And I said, okay, that's as long. And by the way, and here's the thing, this might give you another idea about the trading group. we had full bore conversations in this period and this period about exiting here. That the decision was made 2 weeks before it occurred. Okay? And then the next time, the next meeting is getting in here. And so we talked about, will you have the conviction to get back in? Because it's easy to get out and you got all this profit, but the thing is your job's not done. So you do things like you look here, and then you look here, and you look here, and you start planning these things, and you're like, okay, well, I probably have a plan A, which is something like this, and a plan B, which looks probably something like this, but you're planning your zones, okay? And you start getting analysis like, okay, I definitely want back in, and, for example, you're going to pay attention to this. But that's easy enough. That's just technical analysis. Do you have the conviction to get back in? And so we talk about the psychological aspects of trading. How do you do that? How do you get back in? What are the pieces and the components? Where do you get the strength, right? Because it's, right? All that kind of stuff. And the interesting thing is there's a juxtaposition in the conversation, because we talk about, for those that are taking profit there, have to deal with the challenge of getting back in here. But then there's probably more than half the people that had to have the strength and conviction to not get out because they are planning higher. Do you understand that? At least half of us, we're still in the trade watching it come down for an entire week. I'm like, it's okay, baby. That's part of the plan. You planned this down here. You planned this 2 or 3 weeks ago. So now it's coming down and now you want to bail? Well, if you're going to be that frightened, you should have bailed at the top. You got to stick with it. What is your plan? Where are we going? Right? Where are we going to be in December? Because this down here, by the way, is the December trade. That has nothing to do with November. When you hit this, November's dead, bro. It's gone. So most people are like, they're in the day. Like, what's happening in the next 20 minutes? Oh, when the OPEC news comes out, it's going to push up oil by $1. Who cares? Should have been on it 3 weeks ago. Because if you were on it 3 weeks ago, you wouldn't be caring about it today. And sort of same thing, like, dude, we were on like the 11th of November. We were already on our December trades. So this is why I can say now to you, on a lot of these trades, I'm preparing to exit and I'm done for December. And someone's like, what do you mean done for December? It's December 3rd. I'm like, yeah, I'm almost done. Because I've been in my December trade for 2.5 weeks already. So if we hit my profit target early in the week, it's screaming counter trend. Plus, it was the thing I planned for 3 weeks ago. I'm not even making decisions anymore because they've been made. And that's where you go from, hey, will pivot point save me? Will MACD save me? Will Elliott wave save me? And you realize actually none of that really matters that much. Right? If you know how to ride a mountain bike, you know how to ride a BMX, you know how to ride a 10-speed. Okay? Great. Okay? There's some more to it if you're going to win the Tour de France, right? I don't have it, KO. So that's the thing. We can cut through that. We can cut through that so easily. We can cut through that. And in fact, if someone came to me today, I want to do group work in the swing trading group, but often people come through and they're like, yeah, how do I overcome this? And I might spend an hour on that. And I'll just tear that apart and break it down and simplify. I will simplify your trading. Okay? Analysis paralysis, it just means you don't know what you're doing. So I can, right? So the clarity now is to teach you really what's going on, and then you can pick and choose the type of information you need in that moment. But there is no such thing as analysis paralysis. I'll give you an example. I'm shorting the US dollar for the next 5 years. Done. Woohoo! I'm free! I'm free! Right? The liberation, right? I'm free. I know what I'm going to do now for the next 5 years. And it was 1 minute of one speech at one particular time, and I think it was April, and I was done. So there's my analysis paralysis. I'm done. Okay? I only have to adjust for seasonality. But if you don't know what you're doing, or more importantly, why the markets are doing what they do, then yeah, you're searching through analysis to make decisions, but that's not how you do it. It's like you're doing, like, here's an example. You're trying to do something like big data. The term big data is going through billions and trillions and trillions of data sets looking for discernible patterns. But it's difficult for giant servers with massive CPUs to do that. So you're like, how can I look at the foreign exchange market and do big data analysis like I can calculate 1 billion calculations per millisecond? You're like, dude, you can't calculate 1 billion calculations in a millisecond, right? Like, you're going about it all wrong is the first thing. So I just forget that, right? Just forget all that. Just whoa. You're going at it all wrong. So the next thing is, in chaos theory, the way that chaos theory works is you still have this big data set, but what you want to do is bring structure to the chaos, so you're only looking for repeatable patterns inside the chaos theory. So chaos theory isn't about the chaos, it's about the destruction of the chaos. It's the creative destruction of chaos. So you're looking for just the discernible patterns. And luckily, these patterns now, even though there's minute by minute, second by second known variables and unknown variables, like there could be an earthquake in Japan 5 minutes from now, and that's going to change everything in the Forex market. Well, you can't plan on black swans, but they happen. But you should know what to do if it happens. That's easy. Okay? But now, most of the patterns that you need to know, okay, Kale, are things like, what is the central banking policy of a country? What data are they looking at? What decisions have they made? What decisions are they thinking about making in the future? And what is the likelihood of those changes? And the cool thing is, this changes once every 3, 4, 5 years. You see? So you should be looking at Australia through a filter, right? You should be looking at New Zealand through a filter. You should be looking at Canada through a filter. You should be looking at the United States and Europe and all through filters, and the central banks provide those filters. And the cool thing is, it doesn't change very often. Okay? It doesn't change very often. And you'll find out, oh, good. So you can now, from that, create a very simple hypothesis. Oh, dollar's going to be weak for the next 5 years. Done. No more analysis paralysis. Then the second thing is technical analysis. You see? Technical analysis. So what does technical analysis tell you? At this time and at this price, should I sell the dollar? Yes or no? No. Okay, I'm done. See the analysis? Let's do it again. I want to sell the euro dollar. I want to sell the dollar, so that means I want to buy the euro dollar. Great. Is this a good time? So we have time here. This is time. Let's mark it here. Here's a price. Let's do price. At this price and at this time. This is where we are now. Is this a good price to buy this pair? So now you can use any technical tool you want. You following me, KO? Anything you want. Price action, pivot points, Elliott wave, CCI, MACD, stochastics, RSI, any tool you want, a rune oscillator, right? It does. I don't even care. They'll all tell you the same thing. This is not the right time and price. So here, this is how I get rid of it, KO, right? Analysis paralysis. I can only buy this, and I look at this, and this is not a good time or a price. Done. I'm done. That's it. Done. I'm done. Now, how about this? What would be a better price and time? Well, price I want to be lower. So somewhere between there. So let's just move these around. Okay. And it could be now, it could be later, it could have been earlier. But if it happened, let's say London Open, yeah, I could do that. So I could do something like this. That would work. Liberated. Analysis paralysis. Gone. You with me, Kale? I love it when I put these like solid, detailed answers in and the person like asks the question left in 3 seconds. Are you with me, Kale? Rods, did I? Let's see. No. I don't see your comment, dude. Yeah, he's gone, huh? That's so funny. It's so awesome, isn't it? Fix me. I gotta go. Rods, did I get your comment? Oh, have you ever traded Chinese currency? Is that what you're asking? Have I ever done it? Yeah. Oh, they're good. Kale's here. Good. I hope it was helpful, Kale. Yeah, no, I saw it. Do I cover it? No. But I expect the US dollar to be weak. So I can only short that. Okay? Simple. All right, well, it was real. I got to go in a couple of hours. The swing trading group is going to meet. Look at this one. What a nice day on this, huh? Look at that. Nice. Which one is that one? Kiwi. 444 pips, baby. That's a nice one. Yeah, is it 4 hours? Yeah, 4 hours, right? Yeah, so I'll see you guys at 2 p.m. Eastern time. If you want to join our swing trading group. It'll blow you away, by the way. And then there's another group on top of that after you get through the swing trading group. One of the things you have to do is make 10,000 pips without making a loss. Otherwise, you don't get in the group. Wait till you do that. But anyways, if you want to join the group, the first thing you need to do is go to fxbootcamp.com. It's 76% off right now. And you have to watch 50 hours. It says 35, but okay, at least 35 hours worth of videos. You'll probably want to watch them twice. Okay? That you got to have knowledge. Then you're welcome to join the swing trading group before then, but you can't do it until you pay for the courses. So you pay for the courses and it's like, hey, do you also want to join the group? Nice little upsell. So you take that too and you're in. So you can attend today's meeting if you want to, even though you haven't watched the videos. You can join and in 4 hours, we're meeting as a group. Okay? Nice. That's it. There's a sales pitch, 76% off. Very affordable. Money is not going to be the thing that gets in the way of us working together. And it will probably set you up for a pretty amazing 2021. It's a little tricky when you get a new administration coming in. It's going to be tricky. 2021 is going to start tricky because there's going to be the normal forces of seasonality, and then there's going to be the new transition period. Then there's the first 100-day period, but then there's like, is there going to be a stimulus? And who's going to run the Senate? And there's so much known unknowns in the beginning of 2021. It's going to be interesting. So you might as well do it with a group, is all I'm saying. So peace on earth. May the pips be with you. May our profits be above average. Remember, tomorrow's NFP, so I'm not going to be at Forex.Today. I'm going to be at the FX Street YouTube channel. Okay? So it'll be us on YouTube. I guess it's youtube.com/FX Street. Sorry, FX Street. I wasn't sure if I said FX Bootcamp. So FX Street. So I'll be over there. Thank you for being you. Thank you for your positive energy. Right? Thank you for your hard work, your focus, your dedication, your camaraderie. I appreciate your friendship. I wish we could meet up somewhere and have a good old time, but we still can't do it, so it's been an isolated year. But I spent more time with you this year than in many years, right? Because remember, when COVID hit, the first thing I started to do is with the swing trading group, I met with everyone every single day, week after week after week after week after week, to keep you focused, to give you the strength to get out of bed and need to get done, even in the collapse of civilization. So anyways, so I hope it's been a great experience, and I'm already looking for 2021. So I will see you tomorrow at Non-Farm Payrolls. I will see you today at our swing trading group, or I will see you on Monday at Forex.Today. Peace. Are you still here? You should go. It's over. What do you, we're done.